$100,000 can be a game changer, whether it's from hard-earned savings or a recent financial boost. The question is, how do you invest it wisely? It's always nice to have options, but you're probably wondering what's the best way to invest $100K. There's no one-size-fits-all answer, but there is a right way to figure it out based on your goals, risk tolerance, and circumstances, especially if you're looking for passive income. Here's a step-by-step guide to determining the optimal strategy for you. In this video, I will show you the 8 best ways to invest $100K for passive income, from ETFs to real estate, and even a strategy that could potentially grow your investment to millions. In the end, I will show you a passive investment that has the potential to turn a $100,000 investment into over $3.5 million and pay over $100,000 in annual dividends. To get the millions out of the strategies that I've planned for you, first, you need to ask yourself 3 questions. Can you get yourself out of an emergency without asking for any financial help? If no, then you'll be forced to liquidate assets and use credit cards, and no one wants that. So it's better to plan than to feel sorry. Set up an emergency fund with enough cash to cover 6 to 12 months of living expenses in case of a job loss, a medical emergency, car maintenance, or any other unforeseen expense. And don't put that emergency 10 grand into your locker rather than putting it into a savings account that is more accessible and does not depreciate your money. Now you're secure for a year, but what about your past credit? If you have a credit card or other high-interest debt, do not start investing until you pay it off. Most credit cards have interest rates near 20%, much higher than you can reasonably expect to earn from any investment. So paying it off early with low interest charges can save you a lot when investing in passive income. It's obvious you want passive income money to be able to provide you with what you want at your retirement. Maybe you want to buy a vacation home or pay for someone's college tuition. What I mean to say is that your financial goals will drive your investment plan. How passive or active do you want to be with the investment? Some investments require more work, such as managing rentals. Others, like ETFs, are more hands-off. They're still one of the best compound interest investments. How much of that money are you willing to lose? $1,000? $10,000? All of it? If the thought of losing even $1,000 scares you to death, then you'll want to avoid anything too risky. When will you need to access the money? Need to use your $100K soon? You should keep your funds in highly liquid vehicles, such as bank accounts or short-term CDs. The general rule of thumb is the longer the time frame before you need to start accessing the money, the more risky the investment can be. The idea is that you'll have plenty of time for the asset to rebound if it falls in the short term. Now, emergency funds, check. Debt cleared, check. And goals, check. Now let's get to know how to make the money work for you. Here are the 4 best strategies for maximum passive income out there. Most of them have the potential to make you millions if you play your cards right. First is ETF, or as I like to call them, Effortless Treasure Fund. Buying individual stocks spreads your money around. There are firms out there who do that for you by selling ETFs or exchange-traded funds. These funds invest in companies and manage the assets for you. ETFs involve less effort than other passive income methods. You just put your money into a fund and watch it generate income for you. It depends on whether you want to sit back and enjoy the show or be part of the show. If you're lazy like me and want the money talk for you, then you will need to put your $100K in income ETFs. They hold income-producing assets, such as dividend stocks and bonds. These funds aim to reward investors with high distributions and target capital appreciation as a secondary objective. When reviewing income ETFs, I've looked into the fund's historical performance, expense ratio, yield, distribution schedule, and management, and found one of the best ETFs out there, the Schwab US Dividend Equity ETF, with the ticker symbol SCHD. This ETF aims to mirror the total return of the Dow Jones US Dividend 100 Index. SCHD is a low-cost fund with a 0.06% expense ratio and is diversified across about 102 securities. The fund has around $54 billion in total assets and has a quarterly distribution schedule. If you go with this SCHD, then sit back and relax, because here's how the future projections look. It has a current dividend yield of 1.37% and a 10-year dividend growth rate of 11.01% and an annual share price appreciation of 7.67%. These numbers show that SCHD has survived the test of time. And if your 100 grand goes into this ETF, after 1 year, it will be valued at $109,040. After 10 years, it will be valued at $242,561. For those retirement fund seekers, if you stick around for 20 years, you will have $622,633 in your pocket to go home to. For millennials who have a long way to go, you will pocket the most. going home with $1,728,085, paying around $55,192 in annual dividends, or $4,599 monthly dividend income. If you're not an ETF person, then the next strategy will pique your interest. Bonds. You know it had been here. One of the best things to do with 100K is to invest it in bonds. They're considered very low risk since they're both backed by the government, but this doesn't mean bonds are risk-free. The types of bonds you decide to buy will come down to your individual risk profile, the current interest rate environment, and when the bond matures. There's a better way than just to wait for the maturity of the bond and then receive the money. You can go for a bond ladder. It is a series of bonds that mature at different times over a period of years. The staggered maturities allow you to decrease reinvestment risk, which is the risk of reinvesting your money when bonds offer too low interest payments. A bond ladder is a classic passive income investment that has appealed to retirees and near retirees for decades. You can sit back and collect your interest payments, and when the bond matures, you extend the ladder, rolling that principal into a new set of bonds. For example, you might start with bonds of 1 year, 3 years, 5 years, and 7 years. In the year when the first bond matures, you have bonds remaining for 2 years, 4 years, and 6 years. You can use the proceeds from the recently matured bond to buy another year or roll out to a longer duration, for example, an 8-year bond. But there are risks too. While Treasury bonds are backed by the federal government, corporate bonds are not. So you could lose your principal if the company defaults. You'll want to own many bonds to diversify your risk and eliminate the risk of any single bond hurting your overall portfolio. And if overall interest rates rise, it could push down the value of your bonds. Because of these concerns, many turn to bond ETFs, which provide a diversified fund of bonds that you can set up into a ladder, eliminating the risk of a single bond hurting your returns. Taking over from bonds are the real estate and dividend stocks that are saying the same thing as the previous two, which is $1 million for you if you invest your 100 grand with us. So the third strategy is real estate. You're probably not looking to acquire a portfolio of rental properties for $100,000, or maybe you won't be able to do so because of inflation. Most people would happily avoid the headache of being a landlord. So here's how to invest 100K in real estate. REITs are publicly traded investments that own income-generating real estate and pay at least 90% of their taxable income to investors. You don't have to invest a huge amount of money either. For example, the real estate investing platform Fundrise lets you get started for just $10. When I'm asked how to invest 100K in real estate, this is always the answer. REITs are also income investments. When thinking about how to invest 100K for passive income, again, REITs are the answer. For example, some REITs pay dividend yields of 5% or more. Some REITs also pay monthly dividends, such as Realty Income Corp, which would generate a monthly income of between $700 and $900. Although REITs do well in an inflationary environment as owners can raise rents, certain private, non-traded REITs can be illiquid. This is why you need to understand dividend stocks. A quick refresher on how dividends work. Companies that earn excess profit can choose to return some of that money to their shareholders, as sort of a thank you, in the form of regular cash payout. These stocks provide a steady income stream, often paying out dividends quarterly, which means you get regular cash without having to sell any shares. This can be a great supplement to your income, especially if you reinvest those dividends. Reinvesting can lead to the magic of compound growth, significantly increasing your investment's value over time. Dividend-paying companies are usually well-established and have a history of growth, so you can benefit from both the dividend payouts and potential stock price appreciation. This dual benefit can make dividend stocks a smart long-term investment. There are also tax advantages to consider. Qualified dividends are often taxed at a lower rate than regular income, making them a tax-efficient way to earn passive income. Now, which dividend-paying stock should you choose? Well, I have one for you. The Target Corporation with ticker symbol TGT. If you invest your 100 grand here, you can't miss the bullseye of being a millionaire. Because in the first year, you will be getting 3 grand in annual dividends. In 5 years, your investment will be worth almost double, standing at $181,803 and paying around 5 grand annually. In 20 years, it will be valued at $1,099,058. But if you want more, in 30 years, your investment will be worth just above $3.5 million. paying over $100,000 in annual dividends, or about $8,456 in monthly dividends. Now, if you capitalize 100% on dividend-paying stocks, I have 5 52-week low household stocks to show you. Click the video on the screen.